Good morning and welcome once again to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thank you so very much for being here. You know, it's a relatively slow news day, and it's the kind of day where there really isn't a catalyst of sorts, but just a few percolating headlines that are more like two-day-old donuts than freshly baked muffins. It's an important reminder, if you will. Patience and discipline are the most undervalued assets in the markets today. Here's my playbook. Number one, doing nothing is absolutely a-okay. And let me explain what I mean by that. Many investors and traders get into serious bandini because they try to force a setup or a trade or simply because they want to do something. I mean, we've all been there, right? I learned a long time ago, and the hard way at that, that sometimes the very best and most profitable course of action is doing nothing at all. So let that sink in. There is tremendous power in restraint, especially when the markets are jittery, headlines are mush, and the crowd wants to chase shadows. Now remember how this works, this being investing and trading. You don't get paid to invest or trade, but you do absolutely get paid to be profitable. So be profitable. Here's a quick tip that might help if you're not used to thinking this way. Sit on your hands if you must. And I mean that quite literally, so you don't touch your screen and you can't get to the keyboard. Let whatever setup or indicators or analysis you use come to you, not the other way around. This is prime time for watch lists, alerts, and quiet confidence. Doing your homework. Tactics too. Number 2 today, the U.S. 20-year Treasury yield has hit a new high for 2025. Now, I won't repeat myself as we've already covered this several times this week, but in particular in yesterday's 5 with Fitz. But today's headlines are flooded with U.S. Treasury yields reaching the highest level since 2023. Oh my goodness. Yeah. Anyway, let's talk about why this is really happening. Traders are continuing to reprice risk, something we've been talking about since this past Sunday when I told you it would likely be the case this week. Now, the cost of leverage is rising as a function of rising rates, which means that every leveraged up to their eyeballs big money trader is reassessing how much debt he or she wants to carry, and when they're over the limits, they're hitting the sell button to get under whatever thresholds they need to avoid getting pinched in the meantime. So yeah, rates fine, but what's really happening behind the scenes mechanically is very different. People are just trying to shed risk, and that's what you want to understand. Because if you listen to the headlines all day, you're not going to get the right picture, and you're going to be at a disadvantage. If you listen to this and listen to what I'm telling you, now you know what's going on behind the scenes, and that's power. Anyway, my investing tip in this situation is that people fret about the fact that markets are going down. And I say, good, because it means stuff I want to buy is being put on sale. So buy low, sell high. All right, number 3, Altmans Instagram moment. Now, this is kind of a big one, actually. It's not an immediate action item, but it's a big story. CNBC says that Sam Altman's $6.4 billion bet on Johnny Ive has Zuck-like qualities. Now, I don't disagree with that statement. Ive, who was, if you know your history, the design genius behind the iPhone, the iPad, and the MacBook, will now apparently lead creative direction across both I.O. and OpenAI. Now, meanwhile, his design firm, Love From, stays independent and likely charges a bloody fortune for the work he's going to do. Now, this isn't just a hire, but it's a statement. Why would I say that? Because if you know your history, you know that El Zucco, as in Mark Zuckerberg, bought a then tiny 13-person Instagram about a month before Facebook ushered in what was to be the largest tech IPO at the time, ever. And you fast forward to today, the FTC claims that the Facebook buying Instagram, should never have been allowed in the first place because it allowed Facebook to dominate the space to the detriment and competition of users. Yeah. Now, I see this deal taking a very similar trajectory, but there's a twist here, and this is what I want to talk about. This time around, Ive is the design brains, which tells me that OpenAI is thinking about devices, whereas Instagram and WhatsApp acquisition, back when Zucco did them, was very much about taking out competitors that threatened Facebook. So what do we make of this? Well, OpenAI now has a $300 billion private market valuation, which tells me, or at least seems to me, that it's setting up one hell of an IPO when the time comes. I don't know how much will be hype versus substance, but we don't have to cross that bridge yet. Meanwhile, I think it's safe and smart to continue betting on my favorite fruity machine maker. You? Number 4 today, Nike to Amazon. Take me back, please. After 6 years of playing hard to get, Nike is apparently crawling back to Amazon, no doubt having eaten a big slice of humble pie. The company, Nike, famously walked away in 2019, citing concerns about brand control, counterfeits, and wanting a more curated customer experience, whatever the heck that was. Anyway, now, apparently, taking the proverbial high road is less of a concern when the margins are getting tight, sales are struggling, and competition is rising. Imagine that. These are two companies that love to talk about being future forward, but here they are reviving a wholesale relationship that strikes me that's about as modern as a mall anchor store. I mean, just really? Anyway, I've been skeptical of both companies for a long time. Skeptical of Amazon's luxury push and Nike's execution. Neither feels particularly compelling to me right now. So if you're going to own a retailer, at least pick one with pricing power, defensible niche, and which is leading the pack rather than playing catch up. It's a very short list, and frankly, one that the OBA family knows well. So if you're an OBAer, you know exactly which names I'm talking about. Number 5. All right, I'm very excited to see this because this is something that I called, anticipated, whatever word you want to say, prognosticated. I don't use the word predict because that's not the right sentiment here, but I got wind of this a long time ago and put a stake in the water and people laughed in my face. But Hong Kong has just set the crypto standard and the US is still holding hearings. Hong Kong passed a new law this week requiring stablecoin issues to get licensed, fully backed, and properly regulated. Now that's an interesting twist of words given it's coming out of Hong Kong and you know who runs that place, Beijing. The new rules apply to fiat-backed stablecoins, think the USDT or USDC, and they're being hailed as insiders as a global benchmark. Now I agree with that. And here's the interesting twist. To me, this is less about crypto and more about control. Governments are racing to lock down the digital money rails before stablecoins do to banks what the internet did to cable. Stablecoins now have a combined market cap of over $230 billion. And unlike speculative cryptos, they're designed to be steady, as in backed by dollars, gold, or other real assets. Now, I call it boring on purpose and, not for nothing, incredibly useful, especially for cross-border payments, fast settlement, and potentially cutting Visa and SWIFT right out of the dang loop. Something I've also been talking about for years, which is why I've been so insistent that investors invest in digital clearing. Now, my POV in this situation is that Hong Kong gets it. I mean, they really get it. The U.S. is trying to catch up with its Genius Act, but the longer it takes the U.S. to establish guardrails, and other governments for that matter, the more likely we'll see key parts of our financial future get built overseas in China. Now, Dubai was a contender a few years back, but that seems to have been backburnered by AI, at least for now anyway. Now, my 2 cents is that digital currency is inevitable, and the only question is whether or not governments around the world control it. That's why I am very keen to keep an eye on and out for companies that are building infrastructure for stablecoins, tokenized payments, and cross-border rails. Now, the opportunity, as I've mentioned more than once, isn't in the coins themselves like people think. It's in the plumbing, or what this case is, the bits and bytes. Now, my favorite choice in this space has returned triple digits since I brought it to the OBA family's attention, and it could still power a lot higher thanks to developments exactly like this one. The S&P 500, by comparison, to put that in context, has still turned in a very respectable but substantially less 41.40% over the same time frame. You know, the key investing tip here, my investing tip really is, people ask me frequently about hot stocks or hot currencies or hot crypto or whatever. But the real key is identifying great companies that'll be there when you need them, a process that hockey great Wayne Gretzky likened to skating where the puck will be. Now, I'd tell you that I'll be here if you need me, but you already know that. The point I really want to drive home this morning is the same one that got driven into my thick skull years ago. If you're going to be successful in the markets, you want to think proactively by playing to win, not to lose, if that makes sense. And by the way, a massive tip of the hat to every Bitcoin investor out there. The dang thing just tapped another new high. Well done, everybody. Hoo-yah, you rock. Well done. Today's bottom line, ironic, isn't it? Sometimes what you don't buy is just as important as what you do. As always, let's make it a great day. Thank you for watching. You got this, I promise, and I will see you tomorrow.